We'll understand the basics of the Greeks. There's something called Greeks, very funny. Greeks. Okay, the reason it's called Greeks is basically they use the Greek alphabets for a certain price criteria actually. Option prices, what's the stock prices? They move very differently. Okay, the way stock prices move, I think, yeah, the way stock prices move, if you've been trading the options, you have seen, and the way option prices, they move entirely different. Because option is a derivative from the moment's underlying asset, the stock. Now, let's take an example. The number one, I would say pretty simple to understand, is called theta. It's also called time decay. Okay, so this is the month of August, and say for example expiry is August 26. As the time goes near to, as you get close to August 26, your monthly expiration, the option prices keep deteriorating. That's why it's called decay. Like as the time passes by, your option price, something you bought at, for example, 100 rupees, it will become 90, it will become 80, it will become 60, and as it gets close to, say for example, 1 week to expiry, it gets rapid. I mean, it gets speeded up like anything. So, theta is positive for seller and it's negative for buyer. Okay? Theta is good for seller. If I'm a seller and if I sell the options, as the time passes by, as it gets closer to the expiry, the decay is faster, and as a seller I can come up positive with a profit. As a buyer, the time work against you. You need to make the market needs to make a move in your favor as quick as possible, ASAP. So it is negative for buyer. So a lot of income generation strategies, they actually rely upon the theta. They sell faraway options and they just wait for the time to pass. And when the time is done, then they go to the next. They go to the next month. So you keep on selling far OTM options. So yes, theta is time decay. This is one. Now that's how the weekly options came into picture. There were a lot of guys who wanted to make it quick. Option expires in 5 days. 5 days you make it or you kill it. The next, I would say, the most important will be delta. And delta is slightly tricky, so just try to understand. All right, so there's something called delta. Delta is defined as the probability of getting ITM. Probability of getting the stock price in the money. All right. It's also called movement of option price with respect to the stock price. Okay, vis-a-vis, dollar to dollar, rupee to rupee, not in terms of percentage. Okay, for example, 1600 becomes 1610, right? Suppose this is ATM. At ATM, delta is 0.5 at the strike. And it makes sense because there's 50-50% probability that price may go up, price may go down. Yep. So, this will move by 10 rupees. Sorry, this will move by 5 rupees. So you may argue that you will make more money here because the price is moving by 10, while the option price is moving by only by 5. Yeah, but here is the point. The point is, you might have bought this option for just 30 rupees. All right? So your 30 becomes 35, while your 1600 becomes 1610. So percentage-wise, you'll be making more money in the option than the stock price. So delta is nothing but probability of getting ITM, and it is 0.5 at ATM, if it is ATM strike. Okay, it is 0.5 for call and it is minus 0.5 for put, and it actually increases. So to just keep it simple, we'll just take call as an example. If I take both call and put as an example, you may just get it confused. So delta is the probability of getting it in the money. Okay, and this is the ATM. So this is the ATM. Here the delta is 0.5, and suppose here it is 1500. So delta could be 0.6 here, delta could be 0.7 over here, because it is in the money. And this is OTM. So for example, this is 1700. And say this is 1800, for example, we don't know. So here the delta will be 0.3, here it will be 0.1, for other way it could be 0. So this is delta. So we can define it as probability of getting the stock price in the money, and it's also defined as the movement of stock price vis-a-vis the option price. Okay, percentage wise, this is the way it goes. Any questions? All right, when it's, there are some traders who also go for delta neutral strategy. I'm just giving you a brief, we are not going to get into detail of it. Delta neutral, what happens is whenever the stock prices change, they try to adjust the positions and try to bring it back as delta neutral. So wherein they can just balance their positions. Anyways, we'll not go for it. Delta is done Vega. There's something called Vega. Okay. Vega represents volatility. Now this is a little bit tricky. You may have experienced when markets are volatile, the option prices go up. For example, the market is just moving slowly, 100 points up and down, up and down, up and down over here. So the probability of in the money, for example, for the OTM strikes and all is very little. So the option prices will be somewhere around, say, for example, 100 to 200 rupees. All of a sudden, the market starts moving like this. Then the option price, the same 100 to 200 becomes 300 to 400. Okay, like we discussed before, as the volatility increases, the option prices start moving up. Now the volatility is negative for the seller. As a seller, I lose money. For example, market is just over there. Market is at the same level. Nifty at 16,000 only. I sold the options. Nifty is going 17,000 tomorrow, and day after tomorrow it's coming back to 15,000, and then again it's coming back to 16,500. You know, if the movements are like this all of a sudden, even though the market is at 16,000, just because it went to 15,000 one day and the 17,000 the next day, and even if it comes back to 16,000, as a seller I will lose the money because the prices have gone up. All right, and as a buyer you have made money because volatility works in the favor of the buyer. So some of the people, what they say sell when the volatility is high in an expectation that the volatility will come down in some time. So for example, if I sell at this position, it will always cool down in few days time or few weeks time. The moment the volatility comes down, the prices drop automatically. Okay, so Vega is about volatility, and I think we covered delta, Vega, Theta. There's something called gamma. You can actually compare Vega to velocity. If you are a science student, I hope you'll understand what is velocity. Velocity is displacement, your distance covered, with reference to time. Okay, and gamma is acceleration. Okay, change of velocity with reference to time. So what happens when the stock prices, say for example you bought an OTM option. We'll always take just one example to make it simple throughout all the classes, and say you bought it at 1700. When the prices are moving slowly, you will experience vega, right? Velocity. It will keep changing. The price of the option will keep increasing because of delta, because you are coming close to the strike. Your probability of getting in the money will go more and higher as you get close to the strike. So due to delta, the price will increase as you get close to the strike. Right. So suppose this is delta, right, and this is 1600. As the price start moving up, delta will get into picture because your probability of getting in the money will increase as it comes close to the strike, and you have bought this option for, say for example, 20 rupees. Okay. Once it hits the strike and when it enters, then the gamma gets into picture. Gamma is very high once it gets in the money. So the price will start moving up very fast. So the price is actually, okay, delta plus gamma. So that's why a lot of option sellers, they sell the position the moment it gets in the money. They have this principle. The moment it touches the strike, exit. Don't stay in that position. So whenever you sell ATM options, you usually put the stop loss at 30% because we don't want it to getting it in the money. For example, you sold an ATM call and ATM put. Okay, you sold an ATM call and ATM put. You might have noticed this. Okay, suppose this is call and this is put. As the market starts rising, if you don't sell this call at 30%, if you don't sell this call, and say for example the price doubles, this loss will be much bigger than this profit. Okay, this profit will not compensate for this loss. So this is not linear. This is not like shorting, like you bought one and you sold one, right? In futures, you buy and you sell. If you make 1,000 here, you lose 1,000 here. It is linear. But when it comes to the options, it's not straightforward. That's why options are complex, and that's what people are like, nahi yaar, wo samajh mein nahi aata, theta, vega, gamma and all. But it's actually not that difficult. So once you understand the concepts, what are things, even if you don't understand, if you start trading slowly with a limited capital until you get comfortable, you'll be fine. So, okay. So these are the Greeks. Every time the option prices depend upon all these things. Where is the strike? How are the prices moving? Where is the expiration? And is it in the money or out of the money? Delta, gamma, vega, and all these things in place.